Welcome to this explainer. Look, let's get something straight right out of the gate. Most amateur investors treat market crashes like they're sudden lightning strikes, right? Unpredictable, terrifying acts of nature that just come out of nowhere to nuke their retirement accounts. Well, don't kid yourself. If you've been around the block long enough, you know the ugly truth. Market crashes are highly predictable, mechanical wealth transfers. It's a cycle as old as the ticker tape itself. Today, we're going to look closely at the structural warning signs that the smart money actually uses to survive and, honestly, to profit from the chaos. Let's get into it.
There's a saying that goes, stock market crashes rarely arrive without warning. The warnings are usually everywhere. The terrifying part is realizing who listened. I really want that to sink in for a second. The data, the charts, the structural cracks, they aren't locked away in some secret Wall Street vault. They're totally public. They're flashing neon signs. The problem isn't that people aren't warned. The problem is that the public is willfully blind. You know, the music is still playing and everyone just wants to keep dancing. But believe me, somebody is always listening.
Which brings us to Section 1. The warnings are everywhere. Let's dive right in. Look, before the storm actually hits, there's always a lull. It's this weird period where the public is kept docile, happy, and fully invested. In fact, it's practically a requirement for a true market top that almost everyone believes a crash is literally impossible. Just before the bottom falls out, the media psychology machine goes into absolute overdrive. You'll see these dangerously optimistic headlines everywhere. The economy is strong. We've entered a new era. This time is different. Remember the dot-com bubble? Or how about 2007 when housing never falls? Today, maybe it's AI changes everything. Historically, these euphoric narratives age like milk left inside an active volcano. When absolutely everyone agrees there's zero risk, that is exactly when the risk is at its absolute highest. So what should you actually be looking at instead of the shiny headlines? You need a cold, hard checklist of the structural ingredients that precede almost every major crash. We're talking excessive greed, where retail investors are just totally euphoric. Overvalued stocks, where prices detach completely from fundamental reality. Insiders selling, which we'll get to, but that's basically executives quietly reducing their exposure. And finally, the yield curve inversion. Guys, this isn't some fringe theory. This is the literal autopsy report of past bull markets. All right, moving to Section 2, deciphering the yield curve. Let's put on the professor hat for just a minute to explain the most boring, yet hands-down most reliable indicator the smart money actually watches. Look, stock traders are loud, but bond traders, they're the ones you actually need to listen to. Here's the absolute simplest definition of a yield curve inversion. Normally, if you lock your money up for a long time, say a 10-year treasury bond, you naturally expect to get paid a higher interest rate than, a 2-year bond. That's just common sense, right? You take more risk tying up your cash longer, but sometimes that whole thing flips. Short-term bond yields become strictly higher than long-term bond yields. The bond markets act as these slow, smart, ancient monks of finance, and when they invert this curve, they are basically ringing a giant alarm bell. So why does it happen? The curve inverts because those ancient monks, the bond investors, are looking ahead and they expect slowing economic growth. They anticipate that central banks will literally have to slash future interest rates just to save a struggling economy. They see underlying weakness that the stock market is just way too drunk on hype to even notice. Honestly, it's such a reliable mechanical indicator that the New York Fed itself uses models based entirely on this inversion to estimate the probability of a recession. Now, a quick cynical nuance for you. You'll always hear talking heads get on TV and say, well, the yield curve is broken this time. Modern Fed policies manipulated it. Okay, sure, maybe they tweaked the exact timing a bit. But don't be a fool. Historically, the yield curve inversion has been one of the most feared warning signs on Wall Street. It happened before 2000. It happened before 2008. Ignoring a signal with that kind of track record just because someone says this time is different is exactly how you become the victim of a wealth transfer. Let's hit Section 3, Mania and the Lifeboats. This is where we need to contrast the peak stupidity of retail speculation with the incredibly quiet, calculating moves of corporate insiders.
Right before a crash, the market always feels like a casino at 3 a.m. You'll see glaring danger signals everywhere. Meme stocks exploding for absolutely no fundamental reason. 0 days to expiration options, 0 DTEs, being traded by kids on their phones like literal lottery tickets. You've got cryptomanias, leverage explosions. All this extreme speculation creates a dangerously fragile market. Everyone falsely believes in easy money forever. But come on, it's pure gambling masquerading as investing. But here's the thing. While the crowd is cheering at the casino tables, what are the people who actually run the casino doing?
When the captains quietly move toward the lifeboats, you better believe Wall Street pays attention. We're talking about heavy executive insider selling. The smartest people in the room, the ones who actually see the accounting books, start quietly reducing their exposure. And the wild part? They do it right while the media is still cheering about that magical new era.
Now let's be fair and look at the reality of insider selling. Yes, executives sell stock for totally mundane reasons, to pay taxes, for a little diversification, or because of pre-planned automated selling programs. That's totally normal. But the crucial point is the context. When you see massive, coordinated waves of insider selling across multiple industries, right in the absolute middle of market euphoria, that is a glaring signal of impending instability. Institutional investors notice this, and they quietly head for the exits way before someone actually yells fire.
Which brings us to a really critical concept in Section 4. Cash is a weapon. How do the ultra-wealthy actually defend themselves when the market is flashing red? Spoiler alert, they don't just close their eyes and hold on for dear life. $380 billion. Let that number sink in. That is the kind of record cash and treasury bill reserves recently hoarded by Warren Buffett's Berkshire Hathaway. You know, amateur investors hate cash. They think cash is trash because it loses a few percent to inflation. They honestly think sitting in cash is cowardly. But the smart money, they know that in a wildly overvalued market, hoarding massive amounts of cash is not cowardly at all. It is a loaded weapon. Let's break down that defensive playbook. Step 1, notice overheated markets and completely irrational valuations. Step 2, spot that extreme speculation, all those meme stocks and gambling mentalities we just talked about. Step 3, hoard liquidity, build up that cash mountain. And step 4, just wait for distressed opportunities. The wealthy patiently prepare so that when the bubble finally bursts, they're the only ones left with the capital to buy up assets at a massive, massive discount.
It all boils down to a very simple mindset. Prices are expensive and patience matters. Buffett and the smart money aren't out there with a crystal ball trying to predict a market crash for next Tuesday. They don't need to be prophets. They simply recognize when valuations have become entirely disconnected from reality, and they wait for the inevitable collapse. They step away from the table right when everyone else is eagerly pushing all their chips in.
All right, Section 5, the Great Wealth Transfer. Now we arrive at the brutal core thesis of this entire explainer. What actually happens when the music stops and the bubble finally bursts? We enter the Great Wealth Transfer.
Look at the stark difference in behavior here. On one side, you have everyday retail investors. They're totally emotional, they buy the hype at the absolute peak, and when the crash hits, they panic, and they sell their assets near the absolute bottom just to make the pain stop. On the other side, the smart money. They are cold, they control their emotions, they've been hoarding liquidity, and they step in to buy up those distressed assets for literally pennies on the dollar. See, the money doesn't just evaporate in a crash. It simply moves. It moves from the panicked hands on the one side straight into the patient hands on the other.
And please, don't think this is some rare one-off event. It's a repeating cycle. Take 1929, the Great Depression. People actually thought the Roaring '20s would never end. 2000, the dot-com bubble. They thought the internet meant actual company profits didn't matter anymore. 2008, the financial crisis. They thought housing was this magical asset that only ever went up. 2020, the COVID crash. It is an exhausting inevitability, guys. History just keeps replaying the exact same movie over and over, just with different actors in the leading roles.
So if there's one absolutely crucial takeaway from this entire explainer, it's this. The real game is not prophecy, it's positioning. The wealthy survive and thrive because they strictly manage risk and they hold liquidity. They don't need to know the exact day the market is going to crash. They just structure their portfolios so that when the crash does happen, they treat the devastation entirely as a mechanical wealth transfer that works entirely in their favor. Which leaves us with one final very uncomfortable question you got to ask yourself when you look in the mirror. When the music stops and the wealth transfer begins, which side will you be on? Are you actually listening to the warnings that are everywhere, or are you just dancing to a lullaby? Manage your risk, keep your eyes wide open, and understand the mechanics of the machine. Thanks for joining me for this explainer. Catch you next time.